The big news that I think came out of it, well, two maybe parts of the big news, but one of them was that the Fed is going to end the balance sheet runoff in December. We finally have some inflation data just right before the big event this week with the Fed decision and press conference. So we will be covering quite a bit around interest rates, inflation, and the Fed here today. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered after every interaction. And we have a lot to cover here this week with the Fed meeting. But before we get to that, let's set the stage a little bit because we finally did get some inflation data there just last Friday. Again, this has been delayed due to the government shutdown, but finally last Friday, we at least got the consumer price index data. So CPI came out up 0.3%. And again, that's the headline number. Core CPI came out up 0.2%, which is the strip out energy and food. Okay. So both were slightly lower than expectations, actually. It's good to see. I think in general, this isn't really out of the ordinary for where we've been living for quite some time here now. We had obviously very high inflation for a while. It subsided a little bit, and we've been living kind of right in this range for some time, sometimes higher, sometimes lower. But again, generally, we've been right about here. So although it was a little bit lower than expectations, it's not too far different from where we've been, more recently. But this obviously set the stage quite a bit for the Fed decision and the press conference that came out just yesterday on Wednesday. Really what we're seeing is that inflation is still sticky. I'll talk maybe about some of the areas of inflation, but when we look at the whole number, which is really, if you ever hear me talk about where we see inflation going, that's what I'm looking at. The whole number really hasn't changed a whole lot. That said, again, there are some pockets of it where we are seeing higher increases in prices. And so we can kind of talk a little bit about the Fed's comments there. But fast forward to yesterday, we had the Fed decision and press conference. To start things out, the decision was 25 basis points of a rate cut. No surprise really here. If you had tuned in last month, you might have caught that we basically heard the Fed share that they seem very likely to cut rates through the end of the year. Slight change in that tune here, which I'll share in a moment. But nonetheless, markets, most people expected the Fed to cut rates 25 basis points here in this meeting, and that is exactly what we got. So we're now at 3.75 to 4% on the Fed funds rate. The big news that I think came out of it, well, two maybe parts of the big news, but one of them was that the Fed is going to end the balance sheet runoff in December. This basically means that they are no longer reducing their balance sheet, which is significant, by the way. In other words, when the bonds that they hold mature, they are no longer going to reducing the balance sheet means that when the bonds mature, they no longer will reinvest the proceeds, right? So basically what they're saying is they're going to stop that program, meaning that it ends tightening a little bit. And generally this program, when they are reducing their balance sheet, typically helps to reduce pressure on interest rates as well as inflation to come down a bit. So them ending this, could add a little bit of fuel to that fire to some degree. This is not, I wouldn't say that this is a huge mover for that, because again, money supply is probably the big thing for inflation. But for interest rates, and especially when you look at like 10-year bonds and things like that, it absolutely has an impact because they will no longer be buying a lot of those, which means that, with less buyers and the same amount of supply, we could see, those interest rates, have to pick up a little bit in order to create the demand, right? So reducing the balance sheet is often, again, what they were doing is often disinflationary. So this may not help that they're stopping that, right? A couple of things to mention within the press conference. They had shared that the downside risks have rose in recent months to the labor market. That was the downside risk rose was kind of the direct quote. So certainly something to keep an eye on there. There was a very divided Fed, as probably is no surprise. Some actually suggesting no cuts, some suggesting 50 basis points of cuts. So kind of all over the board here. I think especially as we look a little further out is where that discrepancy starts to widen. But nonetheless, even in this meeting, we had a little bit of a varying of opinions on what to do. Overall, the markets generally were not too shocked by all of this, the stock market. However, yields did spike as a result. Stocks did decrease a little bit. Gold pulled back from a strong day as well. But the yields were probably the big story. We saw, 2-year and 10-year Treasury yields spike quite a bit. And I think, again, part of this was because of the stopping of the reducing of the balance sheet. I know that it's kind of like hard to follow this whole path here, but again, the Fed was reducing its balance sheet. They are stopping. And so they're no longer not reinvesting. So anyways, I think because of that, we saw yields spike a little bit. But in addition to that, the Fed Chair Powell also shared that the December rate cut is far from a foregone conclusion. And I think that, based on the last press conference, it seemed very clear they were going to keep cutting. This was maybe a hedge so that they have the option in December. Time will tell where we land at the end of the year there, but certainly a bit of a change in tune from the press from Fed Chair Powell anyway, as far as what they may do in December. Whereas again, last meeting, it seemed very likely they were going to cut at least through that meeting. Now it's maybe a little bit more of a toss-up. All right. So we'll continue to watch that. Data will hopefully drive some of that, in anticipation. So we'll be sure to keep you posted as we get closer to that December meeting. But certainly not a foregone conclusion is the key there. He kept saying that this really puts the central bankers in a difficult position, given obviously the inflation concerns and the labor concerns working in different directions. So he shared, they plan to go at a careful pace due to the risks on each side. No real surprise here, but that's kind of the key takeaways. Most of it was very similar to the last conversation. But again, the big things were that they are no longer going to they're going to end the balance sheet runoff, and they are also not set on a December rate cut at the moment. So those are the big pieces to pull out of there. As far as just a quick update of where this took everything, markets closed with gold down roughly 38 basis points or so. The S&P was basically flat. Some different indices, NASDAQ, for instance, was up slightly. I think the Dow was down slightly. But again, treasuries were the big one. So the 10-year yield went up about 0.089%, closed at just over 4% for the yield itself. And the two-year treasury closed up 0.108%. So closed at 3.6%, just slightly over that. So again, that was the big story. I think the big thing to watch was yields. The markets really, not too much of a reaction, stock markets anyway. Okay, this week we are going to skip the question of the week because of the big focus on the Fed, but be sure to tune in next Thursday. We do actually get some more inflation numbers tomorrow. So we get PCE inflation, spending, and income all tomorrow before we kick off jobs week there next week. So we'll have a lot to cover, and again, a good follow-up. As far as I understand it, the PCE numbers should actually come out tomorrow. So a good follow-up after the Fed press conference there and decision to see where those numbers take us as well. In the meantime, have a great upcoming weekend, and we will see you next Thursday at 3.